Hello, and welcome to our next nap. My name is Irina Oshkova, and I'm your nonprofit auditor. I design these naps to give back to nonprofit community who I've been lucky to serve for many years. Some my experience and knowledge about accounting for nonprofits and my viewpoint as an auditor where nonprofits can benefit from what accounting issues typically arise in nonprofit industry, and I'm as an auditor would like to give my view of accounting treatment of various accounting and finance issues. Before we start, it's a full disclaimer that my videos are not authoritative in nature. Once again, I'm just sharing my expertise, knowledge, and skills that I learned over the years, but they are no means are authoritative guidance. If your nonprofit have any specific issues, please consult your finance team, your own auditor. Thank you so much, and let's start. In a previous snap, we discussed various financial positions that nonprofits, various financial statements that nonprofit have, and should analyze all of them for main financial statements in order to obtain a full picture of nonprofit. And those four financial statements: statement of financial position, number one, or balance sheet. Number two, it's statement of activities or income statement. Number three, statement of functional expenses. And number four, cash flow statement. So we discussed in detail statement of financial position last time. Today we will be discussing income statement or statement of activities. This statement is you guys probably very familiar with the statement of activities or income statement or profit and loss statement. This statement has a lot of names, but and most likely finance team and management team is very familiar with that statement, because this is the statement when all finance teams and board of directors and management team look quite often to see how much revenue organization earned and how much expenses organization incurred. And because of that statement is so critical, it very often not properly performed or not properly analyzed. And today we're going to demystify and make sure that we look at the main areas on that statement. So first of all, let's make sure that financial statements are prepared based on GAAP. GAAP is general accepted accounting principles. Another basis of accounting that is very often used by small nonprofits is a cash basis. Cash basis we will not be discussing because it's simply not under GAAP acceptable statement. And cash basis, it's very easy. It's revenues recorded when money arrived, and expenses recorded when the money actually paid, physical paid money. So it pretty much shows the cash flow of income and cash outflow of expenses. Once again, I mentioned that it's not appropriate statement under general accounting acceptable principles. So we will be talking about accrual method of accounting. So under accrual method of accounting, revenue in nonprofits should be recorded when, number one, if it's contributions, when they're unconditional promised, or if it's earned revenue, when it's actually earned, and expenses needs to be recognized when they have been incurred, not paid. So statement of activities or profit and loss statement has two main parts. Number one, it's a revenue and support. It's income, revenue. It's everything that the organization earned and entitled to. And expenses, it's everything that organization incurred or have to pay. And income statement, this is the statement of revenue expenses for specific period of time. It does not get carried over from one period to another. It's actually indicates activity for a period of time. It can be months, can be quarter, can be year, can be 5 years, whatever period management decides to do and look at. This statement is great to use for various analytical purposes. For example, if nonprofit runs income statement for a year, it can compare it to the budget and see how organization underperform or perform better than projected budget. Or nonprofit can run a trend for 5-year presentation and compare to see how the organization grew or performed over 5-year period, comparing each year. That as the auditor, I do that presentation very often, and I know that board and management always surprised to see how organization grew or changed over the period of time. So nonprofit can compare to previous periods or against the budget or former budget or future budget. An organization can also break it down and do financial profit and loss statement by months and see the fluctuation of revenue expenses over the period of time each month, because sometimes expenses could be in one month could be higher than another. It could be seasonal. Even collection of revenue can be seasonal, and that is great tool when management can use to do cash budgeting. For example, if majority of revenue comes in December and in January the revenue is actually declining, the management would know in order to sustain expenses for January, it needs to put some of that cash that came in or income that came in December as a reserve for January, and so forth. So this is overall of the statement, but the main purpose of the profit and loss statement, what everybody looking, it's net income. We'll call it net income, but it's actually change in net assets, because the nonprofits do not have income. So it's change in net assets. Or it's another word for that, it's a bottom line. It's a difference between revenue and expenses. Ideally, we always want to see that number positive. Positive number meaning that the organization bringing more revenue than incur expenses. Why it's important? Because it's very critical to see that organization can sustain its level of operation. It does not spend more than it can generate. Saying that, however, in nonprofit, revenue recognition for contributions could be very misleading for some board members who used to read income statements for for-profit companies. Why is that? Because as we discussed in the previous SNAP, revenue recognition for nonprofits, for contributions, we do recognize the full amount of promise as soon as it's unconditionally promised. Therefore, revenue amount for multi-year promises could include amounts that nonprofits will receive in future years. For example, nonprofit receive a promise for 5-year pledge, unconditional $100,000 every year. Based on revenue principle recognition under GAAP, whole 5-year promise needs to be recognized in year 1. Therefore, $100,000 multiplied by 5, it will be $500,000 recognized as revenue in a profit and loss statement in year 1. In that year, we will see great net change in net assets or net income. However, expenses will come later in year 2, 3, and 4 without that support, because support was shown in year 1. And we might see in year 1 great net income. In future years, we might even see losses. If we just look in the profit and loss 1 year separately, it will be very disheartening to show that the organization has losses year 2, year 3, year 4, and would say it's not a good presentation, not good performance of nonprofit. However, it is important for the management explain to the board members that under GAAP, we have to recognize revenue in year 1, but we continue spending it in year 2, in year 3, in year 4 and 5. Therefore, it's okay to see the small losses because we continue spending that unconditional promise. Therefore, it is very critical in such circumstances, look in the P&L statements not in just 1 year, but in 5 years, to show that we received that money and now we're spending this money. So as you can see, P&L statement is very useful, but we need to know how to analyze it and how to look at it prospectively and also retrospectively sometimes. And for expenses purposes, because they can also fluctuate between months and periods, it's also important not just look in one specific period of time, but look in some periods and compare periods. Now, let's take a look at revenue section very briefly. Revenue section, it's critical to have sufficient amount of various type of revenue that organization has. An organization, as we discussed in previous NEPs, can have revenue, earned revenue, it can have contributions, it also can have income for special events, special fundraising event, it can have rent revenue, it can have memberships dues, it can have investment return. All these various type of revenues have to have their own line in profit and loss statement for revenue. So typically nonprofits will have lines for contributions. Sometimes they would have bequest separate lines. They would have lines for federal, if they have a federal grants, typically they would have a separate line for that. They can have a program revenue. Then they can have a fee for services line, special events, investment return, and maybe miscellaneous other support, rent income, and so forth. There has to be sufficient amount of various accounts in the revenue section, so different type of revenues are very clearly identified. And expenses, as we discussed in a separate NAP, we devoted the whole NAP for expenses. Chart of accounts for expenses should not be super overwhelming, otherwise it becomes very difficult to manage, but it has to be sufficient so expenses are segregated by natural type of expenses. For example, typical expenses would be salary and wages, payroll taxes, payroll benefits, advertising, travel, fees, consulting services, rents and utilities, gift and grants to others, depreciation and amortization, in others. Sometimes as auditors, we do see expenses called as a reimbursement. Reimbursement is not natural type of expense. Reimbursement, it's how the expense was paid, not natural type of expense. So expenses needs to be segregated on the face of financials by natural type. Therefore, use of expenses such as other, if it's material number, or reimbursable, or bill.com, or credit card expenses, or other names of expenses that do not indicate natural type, but rather how the expense was paid, it's not proper category of expenses. And once again, then we have a bottom line, which is net income. If organization has net loss, hopefully there is a good reason and why organization losing funds. And if there is really not sufficient explanation and it's organization actually cannot sustain its operations with the funds that it's bringing, there has to be a plan that management and board develop in order to at least break even in future years, because that's not sustainable way to operate nonprofit. Once again, just to summarize, income statement or profit and loss statement or statement of activity, it's very important statement to analyze operation, revenue, and expenses of nonprofits. Management need not just to look at it as on an annual basis or quarterly basis. I would invite management to compare profit and loss monthly against the budgeted amount, against previous years. It will indicate a lot of useful trends and provides a lot of ideas for the management and program folks how to improve overall performance of nonprofit, where there's potential opportunity to increase revenue and where potential opportunity to manage its expenses better. Thank you so much. I really appreciate you being here with me. Hopefully I gave a sufficient overview of income statement, and I'm looking forward to see you for future NAPs. Once again, thank you so much and see you next time.